Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. In March's show, we're going to answer two questions. Has MiFID II failed to deliver transparency? And will equivalence disputes threaten derivatives trading? I'll be debating these points with our guest, Amir Khwaja, CEO of Clarus FT, and with a roundup of the first quarter, including updates from the recent AFME Market Liquidity Conference held in London. Market data is provided by MTS. Amir, welcome to Trader TV.
Great, thank you for having me.
So, talking about MiFID II, it was supposed to be this landslide of data and to provide a huge amount of transparency. But this month, we've been hearing from buy-side traders that in fact, almost nothing has changed in the fixed income markets. Now, people have said this is down to a couple of reasons. One is that basically no corporate bonds really of any scale have been captured by the reporting requirements under MiFID II. And the other is that a very odd set of government bonds have been caught by the reporting requirements. Now, at Clarus FT, you guys look at this data. Looking at the depth of data and the breadth of data, what would you say about what's been published so far and what's been received?
Yeah, so I would say, I would say it is disappointing. So on paper, MiFID II promised a lot of data, and there's data out there, but unfortunately, there's not much information in that data currently. And I think partly it's down to the scope, and so there's a pre-trade transparency, post-trade.
Yep.
And in our blog, we focus more on the post-trade volume in the markets. And what we find is it's been very difficult to aggregate information across trading venues.
Okay.
And I would give a few reasons for that. I think firstly because the venues have marketed their businesses.
Yep.
So they haven't been made as straightforward to collect the post-trade delayed free data.
Yes.
As it could have been. I think secondly, ESMA decided to require ISINs to be issued for every OTC derivative.
Yes.
And each day a new 10-year interest rate swap has a new ISIN. So that's made it very hard or overly complex to aggregate volume across time and venue and day. Yeah? So for example, there are now over 5 million ISINs that have been issued, new ISINs for derivatives. Mm-hmm. So I think that's the second reason. And thirdly, I think there's all these deferrals in place. So unless ESMA declares a product liquid,
yes,
it's not made transparent on a pre-trade basis.
Yep.
Hence, certain bonds were captured. But I think that will be recalculated or recalibrated on a quarterly basis. But also, there are deferrals in place for large trades that are above market size, right? Mm-hmm. And I think those deferrals are not straightforward. So it can be 2 days, can be up to 4 weeks. So what that means is it's very hard to figure out which venue is deferring what in what time frame to find volume on a given day and a given issue and a given derivative. And that's what we found. So lots of data, but after 3 months, quite disappointing in the information that we can glean from that data.
Sure. So there's inconsistency in the data, type of data, the timing of it as well.
So as the market or the users give feedback back to ESMA and the regulators and the venues and the APAs, there will be improvements made, and we'll be able to get liquidity aggregated across venues in an automated kind of transparent fashion. Right?
Yes.
So I believe we're 6 months away still from that, mm-hmm. right? And I think that will give sort of investors a true idea of how much trades on a given day in a given size in a given instrument.
Yeah.
And the bond market, in Europe has certainly lacked volume transparency.
Yes.
I think price has been there, right? So if you're investing and you have access to trading platforms, there's always been price transparency, but not much transparency on volume across venues. Mm-hmm. And as you know, price and volumes are two sides of the same sort of coin.
Yep.
How does a large trade impact price? It's kind of important. So if we can see daily liquidity across venues on certain bonds and certain derivatives, that should help investors, get a better price.
Yeah.
Right?
That's great. Thank you very much. And secondly, I'd like to talk about the threat that equivalence discussions seem to be having to the trading of derivatives and the clearing of derivatives at the moment, and the impact this could potentially have on portfolios, fixed income portfolios. So we had a proposal from the European Commission that any significantly important third country central counterparties, they're the clearing houses for derivatives, may be subject to European regulation rather than equivalence that's been previously agreed in 2016. Brian Quintenz from the US CFTC, the derivatives regulator in their market, said that this is akin to the EC tearing up the 2016 agreement, and in very strong words said that this would not be acceptable. Now, this has all come about basically because of Brexit and the discussions about euro clearing happening in Europe rather than in the UK, in mainland Europe. Could you just describe, first of all, how transatlantic is the derivatives clearing business at the moment?
Sure, yeah, of course. So I would say, so it's a global business. So for example, so if we look at OTC interest rate swaps, so I think LCH in the UK clears over 90% over 95% of euro interest rate swaps, and about 85% of US dollar interest rate swaps. If we look at futures, they're primarily cleared at CME in the US in euro dollar bond future. Eurex clears in euro, and ICE on life over here. So I'd say it's a very global market. And I think the ECB has always been uncomfortable with the size of euro swaps clearing at LCH.
Okay.
And I think it stems from that. And if you remember, there was a case that about 5 years ago that went to the ECJ in terms of
that's European Court of Justice.
European Justice in terms of should euro clearing be outside the eurozone or not.
Yes.
Yeah. And I think in terms of the market and the investors, I think there's great efficiency in having one clearinghouse clear swaps in different currencies. So having both euro and US dollars in the same clearinghouse, LCH, has benefits in terms of margin, and that's something we've looked at in our blog, right? So I think the fact that both dollars and euro is cleared at LCH in London is good for market participants. It kind of lowers costs.
Yep.
As soon as you move some currencies out of that kind of franchise, it increases costs for investors. And what we have seen is that there's now a price differential or basis for the same economic instrument that's cleared at CME or LCH or Eurex, purely due to the margin benefits of having more risk in one pot that can be netted and cross-margined.
What does that mean for an end investor in terms of their costs?
So I think what that means is, so if the EU were to mandate that EU firms had to clear in a EU zone entity, then primarily investors would end up paying more costs because there'd be a price difference between that and where current liquidity is. Yeah. Until liquidity moved. And as you know, it's very hard to move liquidity on contracts, right? So once a market forms, there's network effects with more participants. It's very hard to shift liquidity. And I think, and the market values scale and efficiency and low cost, right? So regulations can obviously interfere with that. Yeah. And that means that certain investors end up paying a higher cost.
There was a recent report from Union Investment, the asset management firm, which said that about 30% of costs post-trade are flexible and could be reduced if euro clearing was brought into the eurozone. Do you think that there's some variability in who might benefit from that? I
think so, yes. So I think, some investors, benefit from the current status quo. Some benefit from a change. I think, if you're doing a lot of futures versus swaps, then you could cross-margin between the bond future and euro interest rate swaps and Eurex. Yep. And that would save you a significant amount of margin in the same way that you're able to cross-margin between the Treasury future and US dollar swaps at CME. Right? So there are some investors that would benefit in fees and margin execution fees on that premise. But there are also current investors that benefit from the scale LCH, where you're able to cross-margin all currencies in interest swaps in one pot. Yeah. So I would say it depends on your perspective and your trading strategies as to who would benefit, right? But I think but that often comes down to a market choice, right? Which people have now, right? I'm not sure it requires a regulation to kind of enforce that behaviour.
Amir, thank you very much.
Great, thank you for having me.
I'd like to thank our guest, Amir Khwaja, CEO of Clarus FT, and you for watching. To see our insights into trading cryptocurrency this month, or to subscribe, visit us at tradertv.net.